Stock market's been on a tear thus far this year. How do you manage the stock market volatility from here? I've got 4 ideas for you, that and more coming up. My name's Mike Bernard, I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. My guess is this year's stock market performance caught a lot of people flat-footed. Based on the number of comments that I heard last year about how it just doesn't feel safe to invest right now. I'm not going to invest in my 401k until things get better. I feel like every time I invest, I'm throwing money down the drain. And I created a lot of content to address those concerns, and yet those concerns are real and they're valid. However, it's when the stock market's going down, when it's plummeting, when it's unpopular and not enjoyable to invest, those are the exact times that you need that persistence, you need that discipline, you need that grit to continue to invest, because those are the times when you should be buying low and riding through it. And so my guess is this year's rally, overcoming Fed rate hikes, the fear of a recession, the regional banking crisis, the debt ceiling, all of that sort of stuff, my guess is it's caught a lot of people flat-footed. So what do you do from here? How do you manage, what are some investment strategies to consider to manage the volatility that we've seen and the volatility that we're likely to see? Number one, the tried and true diversification. And I know that's going to sound unpopular, because you're going to say, oh, I need something more than that. I need something more creative than that. Well, I've got 3 other ideas, but listen, you gotta reconsider, or go back to blocking and tackling. Okay, you've got to go back to the basics, to the foundation. And diversification is based on the idea: don't have all your eggs in one basket, because that's going to help you manage risk and mathematically lead to a better risk-adjusted return over the long term. And that's true, guys. That's true. The math still holds up. So therefore, as the U.S. stock market has rebounded, even though earnings have not, you might look and say, well, the U.S. stock market's a little expensive right now, or large cap stocks are a little expensive right now. Maybe I shouldn't jump on the bandwagon. Well, there again, you're going to want to have diversification. International stocks appear cheap. Small cap stocks actually appear cheap as well. So making sure that you have a disciplined, diversified strategy can help you manage the volatility. Further, for those of you closer to retirement or have a little bit lower risk tolerance, bonds also. This is another reason why diversification has felt worse. You're always going to be frustrated with diversification, because there's going to be some leaders and some laggards. So does diversification, that's one of my favorite investment quotes, does diversification work? Yes. Will you like it? No. Because being diversified means you're always going to hold some investments you wish you held more of, and you're also always going to hold some investments that are underperforming and wish you didn't hold. That's diversification, okay? But bond investments last year, for those of you in retirement or near retirement, it's the worst year in the bond market index in history. It's been around for 50 years. Going back past that, the bond market, it was just an awful year in bonds. And I'm not jumping on that bandwagon either, but bond investments work inversely to what's happening with interest rates. So if interest rates went from 0 to 5% last year, that's a big increase, very steep, fast increase. Bond values, bond investments drop precipitously. So now this year, are we going to go from a 5% interest rate to 10% interest rate? Well, if we did, then bonds will likely have a similar performance. Most of us are seeing the signs with inflation and so on, saying, I mean, the Fed might need to raise interest rates a little bit more to make sure things don't get out of hand, but to continue to raise interest rates at that magnitude seems unlikely. Therefore, not that I would say bonds are a safe haven or that they're going to provide some explosive growth. I don't think that, but they shouldn't have a repeat performance of last year. Therefore, first idea and the foundation, the bedrock to managing volatility, it would be diversification. Work with your CFP, make sure you've got the right strategy, make sure you're taking the right risk level, make sure you've got the right positions, portfolio to manage that diversification. Now some more creative ideas. A second way to help manage volatility, this is something we're using a lot of right now, is hedging. hedging with our clients. And so how do you do that? It's essentially where you're buying the stock market index, but then you're also buying some options, some hedging, so that you limit, mathematically, you limit some of your downside exposure. And this makes a lot more sense when the stock market is potentially overvalued or priced high, but it also makes a lot of sense during a time period where we're still raising interest rates, and bonds, even though I just said shouldn't have a repeat performance like they did last year, but they're not as reliable as a defensive position as they once were or maybe historically have been. And therefore, owning the index, but then also owning some put and call options to help hedge the downside can help you get exposure to the upside up to a limit, okay, while protecting some of the downside. These aren't perfect. You do give up some upside. Absolutely you do. There's a cap, there's a limit on the upside, but it's really about your risk reward profile, your comfort level. I wouldn't suggest putting all of your dollars at hedge, because believing in the markets long term, there are going to be times when you'll hit that cap and the stock market will keep on rising and you'll have missed out on a lot of opportunity there. So, but for a portion of the dollars to hedge the downside, capping your upside potential but limiting some of your downside, it might make a lot of sense, and certainly to manage the volatility. Third idea to help you manage volatility right now is also using options, but it's premium income. Okay, it's equity premium income. Okay, so here's the idea. You might be familiar with the idea of the term equity income, and that is an investment strategy that's using a basket of stocks. So you're buying stocks, equities, but they're dividend paying stocks or high dividend paying stocks. That's the income. And so normally this is the large value spectrum of a diversified market, or you're looking at stable stocks but that pay a dividend, consistent dividend. That's equity income. Premium equity income is owning stocks but then selling options so that you're boosting your return, because when you sell an option against the stock that you hold, you receive that premium, and that's a way to goose up your return. So some of these strategies, JP Morgan has the most popular, the one that's been around for the longest time period. You're still owning the stock market, so you're still going to get all that volatility, okay? Or you're owning a basket of stocks, so you're still going to get a lot of volatility. But you're going to also receive the yield, the income from that manager writing those stock options, and therefore the yield on these things will be double digits, 10% or so. And therefore, if the market's down 10 or your basket of stocks are down 10, but your yield is 10, you'll break even. So that's another way of helping you manage volatility. Last year, that strategy worked fantastic. This year, not as much, as we've seen growth stocks really emerge. But that's another strategy or another diversifier to help you manage today's volatility. And then lastly, you can't really overlook the use of CDs and treasuries if you're trying to manage volatility. It's very possible that for the bond side of your portfolio, say you want a 60-40 portfolio, possibly that 60 you break up between just regular, stock and bond funds or ETFs, but then you also have some that's hedged. And then on the 40% that's bonds, maybe you hold some bond funds for maybe half of that, and the other half you're owning individual CDs or treasuries, so that you lock in that yield and lock in exactly what your expected return is. It's hard to ignore using some of those as a supplement to your bonds when they're paying 5%, and you can sort of lock in your term and lock in what your experience is. However, if thinking back to the early 80s when interest rates were double digits, there's a saying that a lot of clients have said, oh my goodness, if interest rates get back to 10%, we're just going to invest in that and lock that in. That's all we need. Well, you can't lock that in, because that interest rate is only around if you do a 1-year term or something like that. You can't lock that in for 30 years or 5 years or whatever. So knowing that those CD rates and those bond rates, if you tried to lock that in or do a 5-year term or 7-year term, you're going to get a much lower interest rate, and it's going to be much less appealing. Therefore, supplementing or complementing the bond side of your portfolio by using a 1-year CD or 1-year treasury, 18-month treasury, something like that, can help you boost return and help you manage volatility. So to me, guys, you've got to work with your certified financial planner. How do you navigate this? What's your investment strategy? How does it fit with your retirement plan, your cash flow plan, your tax strategy? But to me, using any, but ideally all of those 4 components would really help you manage volatility and give you much more diversification right now. So again, if your portfolio or if your financial plan suggests a 70-30 or 60-40 portfolio is appropriate, taking that stock side and hedging some of it would make a lot of sense while keeping the rest of it diversified. And then on the bond side, having some diversified bond funds or ETFs, but then also having complementing that with some individual CDs or treasuries personally. That gives you a lot of diversification, would help you manage volatility, whether things continue marching higher from here or we see a pullback or a slow economic growth and therefore not a lot of growth in the economy. That should really help provide a more diversified and more managed volatility portfolio. Work with your certified financial planner on that. This is a challenging time to navigate as an investor. Work with your CFP. Make sure it's connected with all 6 areas of your financial life. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.